we are kicking things off with a massive shakeup in the tech world. Jeff Bezos hinted at a breakthrough technology that would define Amazon's destiny. And fast forward a year, Amazon's new CEO, Andy Jassy, is already talking about generative AI being used everywhere to totally reinvent customer experiences. This is huge, and we are diving deep into the massive implications of this shift in how technology is reshaping everything.
Stop using your finger for notes, sketches, and edits. This Jam Jake stylus pen gives your iPad a smoother, more precise writing feel with palm rejection so your hand can rest naturally on the screen. It charges fast, works for hours, and comes with replacement tips. Perfect for school, work, or creative projects. Check the link in the comments to grab it on Amazon.
Next up, we look at the future of robotics with Elon Musk dropping a jaw-dropping prediction at the Future Investment Initiative conference. He forecasted that by 2040, we could see at least 10 billion humanoid robots, each priced between $20,000 and $25,000, leading to a staggering potential market value of $250 trillion. This isn't just science fiction. It's a tangible economic wave we need to understand. Now we shift focus to the market performance in Singapore. We examine why the Straits Times Index slipped, focusing on the familiar trio of Singapore telecommunications, Singtel, Jardine Matheson Holdings, and Jardine Cycle and Carriage, all of which reported underlying profit growth despite the market selling them off. We break down the complex financial details to see what investors are truly watching beneath the headline numbers. Finally, we turn to semiconductor powerhouses. While Nvidia and Broadcom grab the headlines, we spotlight Monolithic Power Systems, which has surged over 70% in 2026, driven by the growing energy needs in data centers and AI equipment. We look at the analyst upgrades and the massive growth projections to see if this is the next hidden gem you need to watch. Don't miss the full analysis, subscribe now, and take control of your investment future. The generative AI revolution is rapidly reshaping global economics, with predictions suggesting a future worth trillions. Following Jeff Bezos's early insights and Amazon CEO Andy Jassy's recent commentary on generative AI, the technological shift is accelerating. Elon Musk has projected that humanoid robots could reach 10 billion units by 2040, valued between $20,000 and $25,000 each, potentially creating a $250 trillion market by that time. This massive economic wave is not centered on a single entity, but on an entire ecosystem of AI innovators poised to redefine how businesses, governments, and consumers operate worldwide. Major consulting firms like PwC and McKinsey also anticipate multi-trillion-dollar potential unlocked by this technology. This profound potential has ignited intense interest among hedge funds and top Wall Street investors. However, insiders suggest that the key to this $250 trillion revolution lies within an under-owned company possessing critical, yet undervalued AI technology. Reports indicate that this company's super-cheap AI technology should be a major concern for its competitors. While established giants like Tesla, Nvidia, Alphabet, and Microsoft capture significant attention, the focus is shifting toward a smaller firm quietly advancing the core technology, enabling this transformation. Market veterans and Silicon Valley insiders are signaling that this prediction is not merely speculative. They believe investors will regret not owning this stock in a few years. To gain a comprehensive understanding of this groundbreaking company and its technology, an exclusive, detailed report is being offered. This premium research package includes an in-depth analysis of the AI stock's growth potential, access to 11 new issues of a monthly newsletter featuring hand-picked stock picks, a free quarterly newsletter, bonus fund manager interviews, and an ad-free browsing experience with a 30-day money-back guarantee. The offer is limited to 1,000 spots, encouraging interested parties to subscribe to unlock what is positioned as a potentially life-changing investment opportunity in the AI future. The Straits Times Index slipped approximately 2% in April 2026, with 3 blue-chip stocks, Singapore Telecommunications, Singtel, Jardine Matheson Holdings, JMH, and Jardine Cycle and Carriage, JC&C, lagging at the bottom of the index. Despite this underperformance, all three companies reported underlying profit growth in their most recent financial results, prompting market scrutiny over investor sentiment. Singtel's third-quarter results for the financial year ending March 31, 2026, showed headline strength. Operating revenue increased by 0.9% year-on-year, and operating profit climbed 5.3% year-on-year. Underlying net profit advanced 9.5% year-on-year, bolstered by a 15.4% rise in the share of regional associates, post-tax profits, primarily from Bharti Airtel and AIS. However, a closer look revealed mixed signals. Operating profit in the Singapore home market declined by 9.7% year-on-year due to intense price competition and lower roaming revenue from mobile services. Growth was heavily reliant on associates and the IT services arm, NCS, where operating profit surged 32%. For dividend investors, Singtel saw positive news, with the interim dividend increasing by 17.1% year-on-year. The company also recycled $1.5 billion from a stake sale in Airtel. JMH experienced a similar pattern of headline growth masking underlying complexities. Its FY 2025 revenue dipped 4% year-on-year to $34.2 billion, pressured by softer contributions from Astra International amid a weaker Indonesian rupiah. Nevertheless, underlying net profit rose 11% to $1.7 billion, driven by stronger performance from DFI Retail, plus 35%, Jardine Pacific, plus 28%, and JC&C excluding Astra, plus 56%. Free cash flow also climbed 9% year-on-year to $4 billion, and the group improved its balance sheet, ending the year with a net cash position of $41 million. JMH management guided that FY 2026 underlying earnings would align broadly with FY 2025, alongside a full-year dividend of at least $2.45 per share. This flat earnings outlook limited potential share price re-rating. JC&C offered another illustration of growth masking softer trends. For FY 2025, revenue fell 4% year-on-year to $21.4 billion, while profit attributable to shareholders rose 5% to $998 million. Profit drivers included a drop in Indonesia's contribution due to softer mining services and a weaker rupiah, offset by a 25% year-on-year improvement in Vietnam and higher earnings in Singapore. The full-year dividend saw only a marginal 1% rise year-on-year, confirming that dividends track core earnings rather than headline profit lifts. The collective performance of these stocks highlights that for investors, the quality of underlying growth and future visibility are paramount, rather than just monthly returns. In volatile markets characterized by rising oil prices and shifting sentiment, the focus shifts to establishing a robust framework for capital deployment. Analysts suggest that understanding factors like dividend sustainability supported by free cash flow is more critical than chasing short-term headlines. Experts advise investors to seek frameworks for navigating uncertainty and building conviction in their holdings. The Straits Times Index experienced a roughly 2% decline in April 2026, with a familiar trio of blue-chip stocks underperforming. Singapore Telecommunications, Singtel, Jardine Matheson Holdings, JMH, and Jardine Cycle and Carriage, JC&C, all registered negative returns despite reporting underlying profit growth in their latest results. This divergence between headline figures and market reaction highlights the importance of deeper analysis for investors. Singtel's third-quarter results showed surface-level strength, with operating revenue increasing by 0.9% year-on-year and operating profit climbing 5.3% year-on-year. Underlying net profit advanced 9.5% year-on-year, bolstered by a 15.4% rise in the share of regional associates, post-tax profits. However, a closer look revealed mixed signals. Operating profit in the Singapore home market fell by 9.7% year-on-year due to intense price competition in mobile services. Growth was heavily reliant on associates and the IT services arm, NCS, where operating profits surged by 32%. For dividend investors, the interim dividend saw a positive 17.1% year-on-year increase, and the company recycled $1.5 billion from an Airtel stake sale. JMH followed a similar pattern. Although revenue dipped 4% year-on-year due to softer contributions from Astra International amid a weaker Indonesian rupiah, underlying net profit rose by 11%. This was driven by stronger performance from DFI Retail, Jardine Pacific, and JC&C excluding Astra. The company also saw a 9% year-on-year climb in free cash flow and a meaningful improvement in its balance sheet, ending the year with a net cash position of $41 million. JC&C provided another clear example of mask trends. While revenue fell 4% year-on-year, profit attributable to shareholders rose 5%. The profit increase was offset by an 8% year-on-year drop in Indonesia's contribution due to softer mining services and weaker rupiah, though this was counterbalanced by a 25% improvement in Vietnam and other operational gains. The full-year dividend saw only a marginal 1% rise, underscoring that dividends track core earnings rather than superficial profit lifts. Market sentiment suggests that the quality of growth and future visibility are paramount. For dividend investors, the focus should shift from monthly returns to assessing whether dividends are supported by free cash flow and the business's capacity to sustain future distributions amidst market volatility. As oil prices rise and markets fluctuate, investors are increasingly seeking frameworks to navigate uncertainty, emphasizing preparation over prediction. Analysts suggest focusing on investment frameworks that guide capital deployment and build conviction in holdings to navigate unpredictable market conditions. Monolithic Power Systems, MPWR, is emerging as a significant performer in the semiconductor sector, outpacing major players like NVIDIA, NVDA, and Broadcom, AVGO, in recent returns, having surged over 70% in 2026. This strong performance is fueled by the growing importance of energy management within data centers, a segment where Monolithic provides essential power chips and modules for various systems, including AI equipment. GE Vernova, GEV, is also benefiting from this trend, with its shares rising more than 60% in 2026. Following its financial results on April 30th, Monolithic demonstrated robust growth. In the first quarter of 2026, the company reported revenue of $804 million, marking a 26% year-over-year increase, surpassing analyst expectations of $782 million. Adjusted earnings per share, EPS, also rose by 26%, hitting $5.10 against estimates of $4.90. The company's forward guidance proved particularly compelling. For Q2 2026, Monolithic projected revenue of $900 million, signaling a growth rate between 35% and 36%, the highest rate since Q1 2025, significantly beating estimates near $817 million. Performance across key end markets was diverse and strong. Enterprise data, encompassing power management solutions for AI and server applications, surged by an impressive 97.7% year-over-year, becoming the largest segment at 32.7% of total sales. Communications revenue grew by 55.5% year-over-year, driven by power solutions for optical modules crucial to AI networking equipment. While storage and computing saw a moderate decline, the growth in core markets more than offset these decreases, highlighting strong business diversification. AI demand remains a primary driver. Monolithic projects enterprise data sales to increase by at least 85% year-over-year for 2026, substantially raising the company's sales floor for this segment. CEO Michael R. H. Singh affirmed the potential for multiple end markets to grow by 85% or more. Despite the strong financials, the stock's valuation remains high. While the consensus price target from channel YouTube sits near $1,600, post-earnings analysis showed significant analyst optimism. The average price target across all analysts issued after the results reached approximately $1,793, implying potential upside of around 15% in shares. However, analysts caution that a slowdown in demand or execution could lead to a significant price correction. Monolithic currently holds a moderate buy rating, though top-rated analysts suggest other stocks present better buying opportunities.